I think the current administration, though, seeing who's in charge of the Treasury, they're a bit more, they're admitting that things are not great and they see the BRICS going towards gold. And yeah, it will be an admission, like Taylor said, of a weaker dollar. And I think it will put a massive floor on the gold price, and we could see gold take off.
Revaluing the US gold stockpiles might look tempting under debt ceiling constraints, but it would have far-reaching implications for the financial system, boosting liquidity and prolonging the Federal Reserve's balance sheet unwind, according to Wrightson ICAP. Whether the US revalues gold to $1,000 per ounce or Musk's audit confirms Fort Knox's haul or exposes its absence, gold prices are set to rise. A full gold vault could push gold to $5,000, reinforcing its monetary clout. Empty vaults might send it past $10,000, shattering trust in the system. Financial markets and macroeconomics analyst Mario Innecco discusses historical gold revaluations and their implications. Innecco notes that gold was revalued in 1934 during the Great Depression and after a failed 1972 revaluation, confirming 147.3 million ounces would solidify gold's safe haven status, drawing investors and central banks alike. Based on fundamentals, Innecco explains that these revaluations acted as a floor under gold prices, eventually contributing to gold's rise to nearly $900 in 1980. He suggests that a revaluation today would be an admission of the dollar system's weakness and could trigger a significant surge in gold prices. BRICS nations are systematically reducing dollar dependency, with the dollar's share in their trade dropping from 85% in 2015 to 59% in 2023. This significant decrease reflects a concerted effort to minimize exposure to U.S. monetary policy and economic sanctions. Based on current trends, Innecco addresses the potential for a gold revaluation in the U.S., noting that despite Scott Bessent's denial, policymakers would likely not announce such plans in advance. However, he warns that revaluation could hurt holders of paper assets like treasuries, emphasizing the importance of owning physical gold to avoid being left holding the bag. Now, we present the clips of Mario Innecco's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, I like to go back in history a lot of times, as you probably know. And prior to 1973, there were a couple revaluations in the modern era, and by modern era, I mean the last 120 years. One was in 1934, January 30th, Roosevelt revalued gold from $20.67 to 35, and that was at the height of the Great Depression. The country was in crisis, and then if you skip forward to 1972, it was the same thing. The country was in trouble. Nixon had closed the gold window the previous year. The monetary system of the world was in chaos, and they raised the statutory price by about 10% to 38, and it didn't work. What it did, it created a floor under the gold international gold price, and gold just shot up, and they had to revalue it again in 1973. I think it was February to 42.22. And again, that put like a floor on the gold price. It's almost like the Treasury wrote a put to the market. And of course, gold went to almost $900 in 1980. And why haven't they done it since then? Well, because it's an admission of failure of the dollar system. And I think the current administration, though, seeing who's in charge of the Treasury, they're a bit more, they're admitting that things are not great and they see the BRICS going towards gold. And yeah, it will be an admission, like Taylor said, of a weaker dollar. And I think it will put a massive floor on the gold price, and we could see gold take off. Definitely. And despite the fact that Scott Bessent mentioned the other day that he's not thinking of revaluation, you would say that if you were thinking of it. You're not going to tell the market, yeah, we're going to revalue. As far as whether it can be done, I think legally in the United States, you need a vote from Congress to change the statutory price. I don't think that would be difficult to get through because I think it would improve conditions for politicians. It would make the dollar weaker. They could keep spending. So I don't see that as a problem domestically. I guess, like Taylor said, if you're holding loads of paper promises or treasuries, uh, if the US were to revalue it to a really high level, uh, it would annoy a lot of people because you'd be left holding the bag. And that's why I tell people they need to have physical gold.
According to Mario Innecco, a gold audit could significantly affect the US dollar. If 90% of the gold is present, it could impact the dollar and support gold prices. However, if reserves are below 50%, the entire financial system could destabilize. An official audit of Fort Knox could reveal various possibilities, each with significant consequences for gold prices, the US dollar, and investor confidence. If an audit confirms that all 147 million troy ounces of gold are present and meet purity standards, it would restore confidence in U.S. financial management. However, this could also prompt a reevaluating of how the government values its gold reserves. Moving forward, Mario Innecco highlights the 40-year bond market cycle, noting that the bull market from 1981 to 2020 followed a prior bear market. He warns that rising credit costs could strain financial assets and sees a shift toward hard assets like gold and commodities. Let's get back to the interview.
In terms of a spectrum, let's say if there's only 90% of the gold that was supposed to be there, yes, it's going to hurt the dollar a bit and help the gold price. But there's the other end of the spectrum. If it's below 50%, I think it could not just hurt the dollar and help the gold price, but annihilate completely the financial system because the fiat currency system is based on faith and credit. And I think in the back of people's mind, they always know that the US has 8,133 tons. And if that's not there, it raises a lot of questions about the honesty of government as well. Uh, yeah, who was guarding the guards in Fort Knox? Uh, and there's a lot of speculation that a lot of the gold was taken out of there in the 60s and 70s. I've heard stories about it in the 90s, the gold being taken out because that was the period when the U.S. started the strong dollar policy with Robert Rubin. And one way to keep the dollar strong is to keep gold pegged down. And if you remember in the 90s, gold went nowhere. And Robert Rubin started out at Goldman Sachs at a department called J. Aaron, which was a bullion dealing department of Goldman Sachs. I'm not saying he stole the gold from Fort Knox. I'm just saying I don't think I'll ever believe 100% what government says unless you have an independent auditor that goes in there independent of government and says, yes, the gold is there, and they give us pictures and all the reports, and all the bars are really assayed and accounted for because a lot of these audits, they take like 20% of the bars, and that's good enough. Well, I'll have to take you into the bond market, which is a market I worked in for 25 years. And the bond market was in the bull market from 1981 till 2020, about 40 years. And prior to that, from 1981 to 1941, bonds were in a bear market. So there seems to be a 40-year cycle. And when bonds go down, that means, so I've been warning about this. Maybe I was a little early, 2019, but I saw that in 2020, there was a crash of all assets. Even treasuries were really uh, very volatile in March of 2020. And the CRB index, the Commodities Research Bureau index, crashed. Gold dipped really quickly from 1750 to 1450. I think silver went down to 12 bucks, but they rebounded really quickly. And silver went to $30. still in 2020, and gold went almost, I think, went to close to 2000 by the summer of 2020. And commodities, the general commodities, only started making a move a little later. Um, yeah, they topped in 2022. So now, looking at the technical picture, it looks like gold is leading the way, and commodities could, I think they're just catching up. And that's why, as well, I think we are in an age of hard assets. The fact that Trump is also bringing out this policy of tariffs is very significant because he wants to take America back to a time when they used to make things and export things and have an industry. The bull market in bonds has been abused in that it financialized the whole U.S. economy. The only sectors that have done well are on Wall Street: private equity, fund managers, hedge funds, and politicians. So I think the balance is gonna, yeah, it's gonna shift. Things like that don't last forever.
These gold market trends point towards a future where gold plays a more central role in global currency systems. Analysts predict that the price of gold could reach $6,800 an ounce by 2040, estimating a rate of return of 7.2% per year. The increasing demand for gold as a safe haven asset and the potential for a global recession also drive the positive gold price prediction. Do you believe an independent audit of Fort Knox could reshape market sentiment and influence gold prices? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.